And Ford beating on earnings but lowering guidance after a fire hit operations at the manufacturing plant of their primary aluminum supplier last month.
In fact, here to help us break down the Ford quarter, what it means for the rest of autos, is former Ford CEO Mark Fields, also a CNBC contributor. Mark, happy Friday. Thanks for being with us.
Great to be here, Carl. Thanks.
What a week between the fire, which we'll get to in a second, but tariff expectations, Ford's comments about EVs. What do you think is most important right now?
Well, I think when you look at the industry right now, the things that are most important for all the automakers are, first off, really trying to gauge demand, both on internal combustion side and the EV side, and then take appropriate pricing, and most importantly, get their cost structures in line for an industry that faces increasing global competition. But, Carl, when you look at the results of Ford or even GM, in Ford's case, they had a strong quarter. They beat on the top and bottom lines, just like GM. And just like GM, they had very strong, truck and SUV sales. So you're seeing the market react positively, overall to particularly the domestic OEMs, where the government just extended the tariff relief on imported parts. In Ford's case, they get an advantage because medium and heavy-duty trucks that are not produced in the U.S. are now taxed. And particularly Ford, GM, and Stellantis, the fact that the government has, relaxed the fines, if you will, on the fuel economy requirements, which will allow them to sell more trucks and SUVs. But it's really gauging that and getting your cost structure in line for an industry that is being attacked by the Chinese domestic manufacturers.
Right. Do you think we turned a bit of a corner chapter-wise when it comes to full EVs and what they will contribute to the overall share of U.S. sales?
Well, I think, you're going to see obviously a pullback given that the federal incentives have come off. But I think you're going to see a gradual growth in the EV market. I mean, let's face it, Carl, eventually, oil is a non-renewable resource. So you're going to see these grow over time, but it's not going to be at the pace that the automakers thought. And that's why you're seeing these big impairment charges that both Ford and GM and others have taken. And I think you're going to see more going forward as the industry adjusts to a new demand curve, if you will, for EVs.
How would you characterize just the overall health of the auto sector right now? I ask this in the context of several pretty high-profile bankruptcies that kind of played into this space. And I'm curious if you think that that's kind of idiosyncratic, if we could expect more, if it's a broader reflection of some of the challenges that you're discussing here?
Well, I think, Leslie, you're seeing the big global automakers in fairly good shape. We just saw the results from Ford and GM. Obviously, they have fortress balance sheets, and they're producing a lot of free cash flow and profits. That being said, you're seeing the supply base under severe strain. And, when you look at just some of the challenges of the last couple of years, whether it was COVID, the semiconductor shortage, and, other issues thrown at the auto industry, the supply base, particularly the tier 2 through tier 4 suppliers, who are the smaller suppliers, are under a lot of stress. And that, to me, you've seen some of that with the bankruptcy of First Brands and some others. That's a bit of a canary in the coal mine. So I think the automakers are very focused on looking at their supply chain and understanding who's strong, who's weak, who do they want to deal with, who do they want to merge, so they have a strong supply base. But I think that's the soft spot in the auto industry right now, of course, depending upon consumer demand, which is holding up pretty well.
Right. We did hear from AutoNation this week as well. I mean, everyone's combing through these calls, Mark, to get a sense as to whether or not subprime has the potential to migrate to bigger parts of credit. But it doesn't sound like it's obvious, at least at the moment.
Well, you have seen increases in subprime delinquencies. But, Carl, I think when you look at the percentage of subprime of the total industry, car industry that's financed, vehicles that are financed, it's still relatively small. And I think whether it's the captive finance companies or the automakers or the big banks, they've done a really good job in tightening the standards, lending standards in that space. So, yes, you're seeing an uptick, but I think in the overall scheme of things, it's not a huge red flag. It is a warning, And I think that's why the automakers are so focused on their business, both on the top and bottom lines through their cost structures.
Finally, Mark, I got to make it quick, but this Novelis fire, it does seem like it's going to come back online sooner than we thought.
Yeah, when you heard from Ford yesterday, I think the good news is Ford mentioned that the impact wasn't as severe as some expected, but they expect this plant to come online towards the end of the year, and it's a certain portion of the plant that produces the smelting and the ingots. So, yeah, it's in good shape. But then you have this Nexperia issue, Carl, this new semiconductor issue. That's a big deal and could be more impactful than the semiconductor shortage versus COVID that we saw back a few years back.
Yeah, market seems to be shrugging it off, though. Those shares up 9.5% right now. Mark, thanks so much for taking your time on this Friday morning. We appreciate it.